Work in progress is an asset and it's created by doing work for someone. A write-up is when we invoice more than the work that we've done. Work in progress is work done, not yet invoiced, the most basic sense. So you can get average hourly rates and recovered rates on people. To investigate write-offs, we want to identify patterns versus outliers. Recovered rates allow us to cut through all the noise. To understand recoverability, we first need to understand work in progress. What I love to say is you can't escape the average hourly rate because it looks at both productivity and recoverability in the same metric. My name is McTavish and I'm the CEO and co-founder of Link, which provides practice management for high-performance firms. My goal for these videos is to teach you the art of firm management, which is centered around 5 core principles and how they all play together. High-performance firms understand that write-offs are a catalyst for good conversation. It allows them to understand where to focus their efforts. Average firms, on the other hand, either ignore them or they use them as a tool to jump on their team members that are seemingly underperforming. The difference comes down to how the write-offs are investigated and interpreted. My name is McTavish and I'm the CEO and co-founder of Link, which provides practice management for high-performance firms. Over the past 15 years, I've analysed the data for more than 1,000 accounting firms all over the world, which allows me to see what the high-performance firms are doing and what the firms that are struggling are not doing. My goal for these videos is to teach you the art of firm management, which is centered around 5 core principles and how they all play together. In today's video, we're going to look at how high-performance firms increase their recoverability. The thing I really want to zone in on is this concept of patterns and outliers as a methodology to investigate write-offs. So first of all, what is recoverability? So recoverability measures how effectively a firm turns effort into cash. So to understand recoverability, we first need to understand work in progress. So we're going to do a little bit of an introduction into work in progress, and we'll look at how part of the work in progress equation gives us our recoverability metrics. So work in progress is work done, not yet invoiced, the most basic sense. What that means is if I do some work for you, let's say my billable rate is $200 per hour, and I do 3 hours of work, I would accumulate $600 of work in progress. That's an asset to me that I can exchange at any point for an invoice with you that you will eventually pay for the work. So the work in progress that I've done, that $600 is work in progress, that's an asset. And then when I give you an invoice, that invoice is also an asset, that's an accounts receivable to me, and when you pay, it becomes an asset in my bank account. So by doing work, we're creating our asset. It's the first form of the asset, the invoice is the next form of the asset, and finally cash in the bank is the last form of asset. So work in progress is an asset, and it's created by doing work for someone. Work in progress can be expressed as a formula, and when we look at it from a formula perspective, we're looking at the movements that happen within a period. So we can have work in progress in a very simple form, $600 of work in progress. That's work I've done, not yet invoiced, it's my asset. But we may want to look at our work in progress over a period because we may have multiple jobs and we want to look at it over multiple clients. And this is where the WIP equation comes into it. So the WIP equation is opening WIP plus our time added, plus disbursements added, less our invoiced, plus our net write-ups equals our closing WIP. So this is a formula that balances. This is science, right? So let's look at adding some numbers to this. So let's say in April 2026, I did $600 of work. So I'd have $600 of closing work in progress. So I started April with no work in progress, job wasn't started, did $600 of time. My closing WIP in April is $600. So what do you think my opening WIP would be in May 2026? It'd be $600, right? It's the opening from the closing from the previous period. So I've got $600 of closing WIP. Now, if I do $200 of time, I'd now have $800 of work in progress because I opened the period with $600, I've done $200 of new time, I now have $800 of work in progress. That's my new asset. Now, if I was to invoice you $1,000, well, now I've invoiced $1,000 and I had $800 of work in progress. So what happens here? We would end up with negative $200 of work in progress. Is that possible? Yes, it is. So at negative $200 a WIP, we don't want to leave that on the job and close it out. What we want to do at this point is we want to recognize a write-up. A write-up is when we invoice more than the work that we've done, right? So now we've got a $200 write-up giving us 0 work in progress as our closing WIP. So if we add along this line, we arrive at 0. So we take 600 and we add 200, we're at 800. And then we subtract 1,000, now we're at negative 200, then we add 200 back in, we arrive at 0. And this would be the completion of this job. So now let's look at a different situation. I want to show you a write-off now. So we have our $600 of opening WIP, but this time we added $1,000 of time. So now we'll have $1,600 of closing work in progress. So if we were to invoice $1,000, which was our agreement, we'd now have $600 of work in progress. That's an asset to me, but I'm not able to bill that asset, right? Because we agreed on $1,000 for the job. So in that situation, we'd need to recognize a $600 write-off. So if we add across these lines, we'd arrive at 0 work in progress. This job is now closed out. So if we invoice more than our billable time, we have a write-up. And if we invoice less than our time, we have a write-off. We have to write some of that time off. So that's the basics of write-ons and write-offs. And that's why understanding work in progress is important, because it's part of the work in progress equation. Now I want to show you one more thing about work in progress, which is negative WIP, which is what we briefly looked at earlier. So let's say in the situation where I was to invoice $1,000, so I create a deposit for this work. I haven't done any work yet, but there's a deposit of $1,000. In that situation, I would have $1,000 of negative WIP. And that's fine if we roll that to the next period. It just means we don't want to close our job out with negative WIP, because that's a write-up that we didn't recognize if we have negative WIP on a closed job. But we can have negative WIP that rolls from period to period. So now if we look at May 2026, we have a negative 1,000 as our opening WIP, also our closing WIP. Now, if we add $700 of time, we've now got negative $300 of WIP. Now, we don't want to close this job out, of course. We want to recognize our write-ups and write-offs. So here we have a $300 write-up, giving us 0 closing WIP when it balances across. Now we can look at WIP from the perspective of our jobs, and we can look at it from the perspective of our job managers and our clients, and a number of different ways we can analyze our work in progress. So when we look at our jobs here, we could have job 1, which has $3,400 of WIP. We invoiced $3,000 and we got a $400 write-off on this job. We could say that this job didn't have great recoverability. Now job 2, on the other hand, time added was $1,900. We invoiced $3,000, so our write-up is $1,100. That's got great recoverability. We've recovered more than we actually did. But we can also look at it from a team member perspective. Now, keep in mind that there is a little bit more complexity that we need to put into this, but I'm going to keep this things really simple by having no opening and work in progress in this calculation here. So generally we have WIP flowing in and out of periods, but I want to keep my example really simple because we want to focus on this time added in the net write-ups, which is going to make sense as we get deeper into this video. So let's say we've got Kate, and Kate added $27,500 to her jobs in the month. No disbursements, we invoiced $30,500, so we have $3,000 of write-ups on this job. No closing WIP because I'm keeping things nice and simple here. Now Ted did $26,300 of time, invoiced $23,400, so Ted has written off $2,900. So he's got poor recoverability compared to Kate, of course. So if we look at Kate's jobs, let's say she's got 5 jobs here, we can analyze the net write-ups that exist on all the jobs, because we just looked at Kate from that next level up. We looked at her write-offs for the month, but we can see we've got some jobs that have write-ups and some jobs that have write-offs. So if we just look at that 3,000, we might think, great, Kate, you've had a good month, away you go. But if we look into it a bit further, we can see that we have this job 4, which we wrote off $2,000. We may want to have a chat to her about this, because there could be something in that job that we didn't understand the scope properly, or we may need to talk to the client for next year about lifting their fee. But if we just look at that $3,000 on Kate's report, we would miss this information here. Now, if we look at Ted's jobs, so Ted also has 5 jobs. Now what we've got is a very different story here. We have one outlier in the data set. So we've got $1,000, $3,000, $2,200 and a $1,200 write-up across the first 4 jobs. But then job 5 has this massive $10,400 write-off. Now if we just look at Ted, we go, $2,900, not a huge write-off for the month. Let's not worry about looking into this any further. But in reality, if we investigate this write-off a bit further, we can see that there's a job here that we quoted $1,200 for, and Ted's put $11,600 of time to. Now, how does this happen? Perhaps we didn't communicate the job budget with Ted, and he's just gone and put as much time as required to it, so we really need to talk to the client about lifting their fee next year. Or perhaps we've gone and incentivized Ted. We say, hey, Ted, your productivity is too low. We need you to lift your productivity. And rather than actually lifting his productivity, rather than putting down an internal time, he's gone and put it all to this job 5 here, hoping no one would see it. And if we're not investigating write-offs properly, we may have not seen it. So that's where we want to look a little bit deeper into these write-offs and see that there's one job here with a massive write-off, and there's going to be so much information in that number that we can find out from Ted. Now, to investigate write-offs, we want to identify patterns versus outliers. So if we look at Ted's jobs, he has an outlier in this data set. There's an outlier of job 5, 10,400. So there's a problem with this job. We need to talk to Ted about what happened with this job. Why did it have such a huge write-off? Now, if we were to look at a slightly different situation, I'm just going to change these numbers around a little bit. So at the same time added, but I've changed some invoice values here just to show what a pattern would look like. This is a pattern of write-offs. So Ted has got write-offs on all of his jobs. So this tells us a very different story. There wasn't a problem with how our job was priced or what happened with that one job. Now we're just seeing here that Ted is slightly underperforming on his rate that we've given him. So let's say his billable rate was $200 per hour. He's probably struggling to work at that billable rate, or our jobs haven't been priced appropriately. But if everyone else is getting no write-offs like Ted, it means that he's not quite performing at the rate that we've allocated to him. So this is a very different story from what we saw before. So if we're looking at Ted and we just go, Ted, you did bad because you got write-offs this month, there's actually more to the story than that. Either Ted is working hard and he's not actually able to deliver at that rate, or there's this one job that he's either stacking time to, so he's actually cheating the system, or we've priced the job wrong, or we have not communicated the budget to Ted. So there's so many different things that be going on if we drill a little bit further than that 2,900 that we're seeing in Ted's report here. Recovered rates allow us to cut through all the noise. So we've looked at write-ons and write-offs, and we looked at how the WIP equation has our write-ons and write-offs in it, and how we can look at them from a team member perspective. But I want to now touch on recovered rates because these are very powerful and a metric that high-performance firms use all the time. So recovered rates are revenue divided by billable time. Now revenue is calculated by the time added from our WIP equation plus our net write-ups. Now, the question becomes, why do we use revenue to calculate recovered rates? Why can't we just use invoice? Because invoiced is already in our WIP equation, right? Let's have a look at that. So the reason for that is because we have WIP that flows in and out of periods, and invoices may not necessarily be associated with the time that's done in that period. So let's say in April 2026, we did our $600 of time, but we invoiced $10,000. That was a deposit that we raised. So now we have closing WIP of $9,400. So if we were trying to recognize a recovered rate for this period here, if we take the $10,000 and divide it by the 3 hours that Ted had done, we're going to find that we have a $3,300 rate here, and that's not useful to us. So instead what we do is we just take the time added, being $600, divided by the 3 hours. The recovered rate in this period would be $200 an hour. Now, let's get into May. So let's say we got our opening WIP here, $9,400. We have $11,000 of time added. So we've got a $1,600 closing WIP balance, but of course we're going to do our WIP wash up to get the write-off. So a $1,600 write-off, giving us closing WIP of $0. Now when we look at this, our revenue for May would be $11,000 less $1,600. So our revenue would be $9,400. Now, if we take the $600 of revenue we've recognized in April, and then we add the May revenue, which is $9,400, we arrive back at $10,000. So revenue always reconciles back to what was invoiced. It just deals with the timing difference about WIP flowing in and out of periods. And that's why we use revenue to calculate our recovered rates. We can't use invoiced. Hope that all makes sense. Now, write-ups are indicative of billable rates, which is why recovered rates are so useful. So let's say Ted's billable rate was $200 per hour. This is what we saw before with the outlier in the data set there. Now, what we're going to do is we're going to focus on time added and net write-ups here, because we know that invoiced isn't useful in this situation, neither are our opening and closing WIP. These are the two values we need to calculate revenue. So then we're going to bring in some new values here. We've got our write-up percentage, we've got revenue, we've got hours and recovered rates. So our write-up percentage, you can see here that time added for this first job was $2,000. We had a write-up of $1,000. That's a 50% write-up. And the last job, we recognized a $10,400 write-off on $11,600. That's a 90% write-off. So we can see our percentages here. Then we calculate our revenue, which is time added plus our net write-ups. The hours that went into generating that time. So very simple here. We can see the time added on the first job, 10 hours at $200 per hour. We arrive at $2,000 of time added. Now our recovered rate is the revenue divided by those hours there. So although Ted's billable rate was $200 per hour, on job number one, his recovered rate was $300 an hour because he had a 50% write-up. Hopefully this is all starting to click now. So across these 5 jobs, Ted's recovered rate was $177.95. Interesting information. We've got his billable rate set at $200 an hour, but he's generating 177 on these jobs here based on the write-ons and write-offs, which reconciles with that 11% net write-up percentage that we're seeing. Now, thought experiment here, we put Ted's billable rate up to $600 per hour. What happens? So the amount of hours he does hasn't changed, but the time added has tripled because his billable rate's twice as much. We can then see his net write-ups, which are a lot higher because that's going to, when we do our WIP wash-ups, it's going to recognize those write-ups based on the time that he's done and what we've invoiced. So obviously huge write-up percentages, but our revenue is going to reconcile back to what we actually invoiced. So if we take the time added, less the net write-ups, we arrive at the exact same revenue. The hours haven't changed, so surprise, surprise, recovered rates have not changed. And that's why recovered rates are so powerful, is because they cut through all the noise of the write-offs, because write-offs are indicative of those billable rates we set for our team members, but they always reconcile back to the actual revenue generated once we invoice these jobs. Now, if revenue is actual time plus net write-ups, and recovered rate is revenue divided by billable time, I've got a new metric for you here, which is average hourly rate. Now, average hourly rate is revenue divided by total time. Now, how is this different? Recovered rates look at the time based on billable hours done, where average hourly rate looks at total time. So if we do have non-productive time, we can bring that in to build our average hourly rate metric. Now, what's interesting here is recovered rates are great for clients, jobs, and services because there's no non-productive time in these things. The clients don't have non-productive time, neither do jobs or our services. Where average hourly rates are fantastic for individuals, teams, and at a firm level, it's because we do have non-productive time when we look at individuals, teams, or the firm. What I love to say is you can't escape the average hourly rate because it looks at both productivity and recoverability in the same metric. So you may have a situation where you say to a team member, we want you to increase your productivity. So they put all their time to billable jobs, right? What they end up doing is they have large write-offs because they are stacking their time against jobs. Where no matter what you do, you can't escape that average hourly rate. So it looks at both productivity and recoverability in the same rate. So let's have a look at this again. So if we take these values here, let's put them on a Ted's monthly performance. So we've got our billable time, we've got our time added, our net write-ups, our revenue, and our recovered rate. This is the numbers we saw in this previous screen there. Now let's add some new values to this. So internal time. Ted did 28.5 internal hours. He took 8 hours of leave. So the total time Ted worked was 160 hours. Now we can calculate his productivity. So his productivity is 82%, which is great productivity for the month. Now the cost. The cost is what we paid Ted. So we take his salary, we calculate what the hourly rate would be, then we multiply it by the total time done. So we want to exclude any leave from this calculation. So let's say of 160 hours, Ted's cost to the business was $7,200. Well, now we can calculate profit, which is our revenue less our cost, $16,200. We can then calculate ROI, so our return on investment, which is 225%. So we take our profit divided by cost. And finally, we can calculate our average hourly rate, which will be $146.25. And that's taking the revenue being $23,400 and dividing by total time, which is 160 hours. And the reason that rate is different to the recovered rate is because the recovered rate takes the revenue and divides it by the billable time. So two different metrics there. So you can get average hourly rates and recovered rates on people, but when we're looking at our jobs, our services, and our clients, we won't have average hourly rates because there is non-productive time to put into that equation there. Now, high-performance firms understand the drivers of recoverability and they analyze their write-offs on their people, clients, and jobs and services. So it's something very important to do is to be analyzing these things on a monthly basis because it gives us insight into where we can put our focus. So that is how high-performance firms increase their recoverability. They understand that there's write-ons and write-offs and they're part of the WIP equation, and then they go a step further by looking at them from a patterns and outliers perspective to identify why the write-offs are happening. And of course, they look at their average recovered rates and their average hourly rates and the two contexts that we talked about, one being average recovered rates are great for clients, jobs, and services, and average hourly rates great at an individual, team, and a firm level. And by analyzing the write-offs and also your rates, you're going to get very deep insight into where you need to put your attention into improving areas in your firm. So I hope that video was useful for you. If you did enjoy it, let me know in the comments what you found most insightful. And if you are building a high performance firm, consider subscribing to the channel. I do put a lot of videos out that build on these concepts that we've seen today. So I hope your firm is doing awesome, and I'll see you in the next video.